everybody. It's John Llodra here with New Harbor Financial Group's weekly client video. Hope everybody is well, and thank you for tuning in. I'm going to try and focus on some key salient points here this week. Mike and I just did a rather lengthy video with Adam Tagger at Wealthion that will be published tomorrow, Friday, the 6th of October. Here we are today, Thursday, the 5th of October. So I'm going to touch upon some really key points, but the one we did with Adam, we'll get deeper into some of these things, because the real headline in markets these days, and this affects many things in the economy, is interest rates. There has been a dramatic spike higher in longer term interest rates on longer term bonds, treasury bonds, and things like mortgages. Just to give you a verbal kind of description of what's happened, back a few years ago, at the lows, you could get a 30-year mortgage for even under 3%. As a result of the sudden spike in longer-term interest rates, now mortgages are approximately 8% on a 30-year, give or take, depending on where you are in the country. So a dramatic spike in interest rates that has real implications on everyday people, certainly with mortgages, but also throughout all aspects of the economy. Corporations that have to borrow to grow their business or whatever. You know, it's very pervasive through the industry. So I'd like to show you a chart just to put that in color, just to show you what's happened here. So this is a chart looking at interest rates, treasury rates, U.S. treasury rates going back to the early 90s, and it shows it for very short-term 1-month treasury bills, 1 year, 2 year, 10 year, and 30 year. And basically, this whole time you've seen a trend lower up until very recently. This is what we're talking about in the headlines right now, and is having quite dramatic effects on financial markets. And we think it's early innings as to what the real effect this will have, particularly on the stock market. The bond market has already sold off pretty dramatically as a result of this, because it's very affected by interest rates. But the stock market, we think, has a lot of vulnerabilities related to this. So it's something to be very mindful of. So as anomalous as this spike has been, it's been the sharpest spike we've seen in any recent history for sure. The real anomaly was this period here, in the wake of the financial crisis, because what happened is the Federal Reserve pushed interest rates down to zero for most of this period. There was a period in 16, 17 up until 18 where they started to raise rates, and things like the stock market and the economy started to falter pretty dramatically. So and then we had the COVID episode in early 2020, and right back again, they brought interest rates right back down to zero. So what really has happened here is a massive distortion of lots of things in the economies. Zombie corporations being able to stay in business because they can borrow money essentially for free. We're now starting to see the consequence of that. So as much as the news headlines wants to talk about this spike as being the real anomaly, history, I think, will go back and show that the real anomaly were these very unconventional monetary policies that were dispelled on the planet, and the consequence was a massively distorted, overvalued financial market. So, and of course, I can't talk about this without talking about the pace at which our government is racking up debt. U.S. national debt, since certainly about 2013, has passed in totality the GDP. And in fact, this is higher. We're over 33 trillion. This is at the end of last quarter. So this is a path that can't be sustained, basically needs to be curtailed. I'd like to just quickly talk about financial markets. Certainly the financial markets so far have reacted pretty negatively to this, the bond market for sure, but also most areas of most asset classes. So the next chart I'm going to show you is just the month of September was a pretty bad month. We're not that far into October, so I thought it made sense to look quickly at September returns for various parts of the market. And I'll pull that chart up right now. So here we are. This is asset class returns for September. Pretty much everything from the S&P 500 to the Russell 2000s small mid cap, to foreign stocks, to bonds of various sorts, to commodities, to real estate, were down pretty healthily in the month of September. And of course, that went a long way to clawing back a lot of the gains that so far this year to date had been registering. So this is a chart of major stock market index returns through October 4th, yesterday. And what you see here is, well, there's what we call the Mag 7. These are the story stocks, the NVIDIAs, the Apples, the the Googles, the Teslas, very richly, we would say very overvalued basket of stocks. And for much of this year, that has been the only show in town. In fact, if you look at the equal weighted S&P 500, basically weighting the S&P 500 capitalization weighted is up about 12.2% this year, 12.3. But if you weight those same 500 companies equally, 1 divided by 500th weight, you have a return through yesterday of actually negative 0.1%. It just speaks to the undue weight of these magnificent 7 stocks on the index. So much of the gains that have been celebrated in the market have been absolutely given back. And some areas of the market, like the Russell 2000, is actually down a little bit more year to date. And if we go back to the peak from January of 2022, as you might recall, was a very bad year for most areas of the market, including the bond market. Basically, this whole cohort is down pretty. So in effect, the stock market, broadly speaking, has not only gone nowhere, it's lost value since January of 2022, the peak back then. Even the so-called Mag 7s are only up a little over 3% cumulatively over that time because they got hammered in 2022. So it's been a very interesting, frustrating couple of years that certainly have made us and you, our clients, a little bit, I'm sure, exhausted, concerned, and ultimately we think that we're in the reconciliation of a big cycle of distorted asset prices. And that's why we're emphasizing keeping things very safe and defensive. We have, for most clients, about 50% or give or take in very short-term treasury bills that are very safe, very liquid, not subject to market risk. And, basically available to swap into any number of other assets at a more opportune time, which we think is coming. I would like to speak to a couple of holdings because as much as the broad markets have been weak, certainly of late and in the month of September, our client accounts haven't been immune from that. And despite our defensiveness, there has been some downward action, a little bit less than the broad markets and a more traditional portfolio. But the downward action has been largely attributable to 2 areas that we think are quite overdone on the downside. That being gold mining stocks and longer-term treasuries. Now, in both cases, we don't have a large allocation. Gold mining stocks, we have a model allocation of about 10%. Some clients have a little bit more, some have a little bit less than that, and those have gotten absolutely, the rise in interest rates have been particularly unkind to those. But we think it's just made them a better value that will ultimately do very well in the period ahead. We're not counting on it, but that is our very strong conviction. The Treasury bond position has likewise, because of the rising rates, has been challenged. But in both of those positions, we do have hedges in place. And I would like to just kind of talk about each of those separately. So let me share my screen and bring up those charts right as we speak. Okay, so this is a chart of TLT. This is a long-term treasury bond holding that we hold in many client accounts. You can see, going back, zooming out to a monthly chart, it's fallen more from its peak in March of 2020 to recent times than the whole stock market did in the housing crisis, the great financial crisis. So a massive pullback in those bonds. We didn't start buying them until this area. So we waited for obviously a very big pullback, but it's been a waterfall decline since then. Thankfully, we put some defensive hedges in place at about $98 a share. So for half the position, the drop below 98 to current levels has been largely offset. So in other words, half of that position has been protected from this decline. We took the opportunity last week to push those hedges down and book some profits on those hedges to 92. So we're still very well protected. But if we do get a bounce here that we do expect is quite possible, we'll start to participate in the upside. So we have very good, robust downside protection, but we do have about 7.5% upside, position upside. But if we do go above 92, that position size will essentially increase a bit to provide more upside participation. The next asset I'd like to talk about is the gold mining stocks, GDX. This is a daily chart, and basically we've had a very swift decline here. But we're comforted in that we have put options right here that basically if the stock continued to go down from here, about 2/3 of the position is hedged. So the quick takeaway, while this trend here has reflected negatively in client statements, if it were to continue, that impact would be only about 1/3, certainly less than the full effect of this period, because these put options would interrupt that downward trend. Now, we do think we're ripe for a bounce here, but even if it doesn't happen, those put options are very robustly protecting the downside. All to say that, the tendency is to want to extrapolate recent days and weeks and assume that trend will continue. Essentially, what has happened with these put options, it's like an insurance policy. And like most insurance policies, you have to pay a deductible before the insurance kicks in. Essentially, the weakness in those assets that have been reflected on client statements in recent weeks and months was essentially the payment of that deductible. Now that insurance is kicking in very robustly. So if we do continue a trend that we've seen recently, the downside will be very much muted. I wanted to keep this video really short and sweet. I would like to call your attention to the video that Mike and I just did with Adam Taggart at Wealthion. It's about an hour long, and we go very in depth into the bond market, the interest rate moves, what we think will likely play out there, and we give data, lots of data to kind of support our commentary there. But as always, we thank you for watching, and most importantly, we thank you for putting your trust in us. We're here to answer your questions and to talk about how your accounts and your financial assets fit into your life. We routinely have conversations with clients about broader range financial planning, decisions about when and how to take Social Security, buying decisions about homes or selling decisions. These are all things that we routinely talk to clients about, and invite you, if this is timely for you, to give us a call. Anyways, thanks again, and we will be in touch, and please be in touch with us if you'd like to chat anytime. Thank you so much.